Okay, I think we can get started. Firstly, thanks everyone for joining on a Sunday morning. Really appreciate that. I think most of you who are here would have, if you are here, I'm assuming you know a bit about us, but I'll just quickly give you a brief about who we are. Just quickly sharing my screen. So myself, Deepak, I also have Shekhar with me on the call. Um, and We both had long careers in data science before coming here. And I think that really helped because we've been very objective in what we've chosen, uh, mainly primarily data driven. And I know we don't have any bias towards any specific asset classes or sectors or even stocks for that matter. Everything is rule based, quant based, or whatever recommendations that we have been providing. And our quant courses are quite popular with many institutional fund managers and some of the big names in India, and so much so that we started also advising them on factor-based research. We've been doing that for quite a while now, and last year is when we've launched a couple of strategies. Both of them are factor based. One is called adaptive asset allocation, the other one is called dual momentum strategy. And adaptive asset allocation is a ETF play. It rotates between factor based indices and gold and debt, right? So be it momentum, value, quality, low wall, gold and debt, right? So in a bull kind of scenario, you could see that moving between momentum and value. In a bear kind of scenario, it could be moving between gold and debt, and so on and so forth, right? So this is uh, uh, low churn strategy, considered to be highly defensive with lower drawdowns compared to dual momentum strategy, which is a stock-based play rotating between Nifty 100, mid small cap 400, gold, debt, micro cap 250. And if you see any future opportunities in asset classes that we haven't seen before, that we haven't used before, we would also add that, right? So something that we look forward to as in when small case launches them. And So here as well, we pick top X asset classes. This is slightly more frequent in rebalancing. We do bi-weekly rebalancing here, but it doesn't mean that every rebalance we make changes to our portfolio. It might so happen that we might continue with the same portfolio, and it happened previously as well with many rebalances. We haven't done any changes to our portfolio. So that's about adaptive asset allocation and dual momentum strategy in brief. Um, with that, I'll hand it over to Shekhar to talk about markets in general, what's happening.
Hey, thanks, Deepak. Hi, everyone. Good morning. So this has been quite a fantastic ride, in fact, the last 1 month, especially post the war starting in Iran. We've been seeing what would happen to the Indian markets, and one after the other, a series of bad news started to creep in. The oil rates went up. The US dollar also started to go up against the INR, and gold was barred. Gold and silver were barred from purchasing. So gold and silver also started to underperform. And then the equities, there was no place to hide except for international. And again, in international, the RBI stopped allowing international investing through mutual fund routes. So it looked like there was no place to hide for the Indian investors. Now there is some respite that we have seen in the last couple of weeks, and I wanted to show you that data. Let me share my screen. I'll walk you through a series of charts one by one to narrate the first chart that I would want you all guys to look at is the VIX. VIX is the volatility indicator. Basically says what is the implied volatility in the coming months in the Indian market. So it is based on the future and options of the index, and that is the implied volatility of what the puts or calls are writing for the coming 30 days. Uh, this going down indicates that there is less amount of premium that is being paid by the investors, expecting that there will be volatility going ahead. And a level below 15 usually indicates a calm, saner markets in the future. The second chart that I wanted to show was the Indian 10-year yields. If you remember our videos earlier when we were doing, we always used to refer to this chart because this was the most prominent chart amongst all the Indian 10-year yields. If you look at the longer term picture, the India India 10-year yields were decreasing since last 20 25 years. If the interest rates decrease, that gives an opportunity for investors to take a risk and invest in higher riskier asset classes like, let's say, equities or anything else. So if the interest rates are high, then the risk appetite would decrease, and people would move more towards debt, and participation in equities would reduce. And this is not specific to Indian phenomena. In US also, this has been the case. The interest rates were decreasing for quite a bit of time. If you see, it is since 1978, the interest rates were in a continuous decline phase. So the low interest rates phenomena started. This low interest rate phenomena, in fact, increases the risk appetite, and that's how the exposure more towards equities or venture capitalists or private equity starts to come in. Now, of late, something has changed, like we mentioned earlier, post the Russia-Ukraine war. The interest rates of the US have started to increase because many of the countries started to ditch the US markets, worrying that they might hoard or they might blacklist their assets. And holding a US dollar is like a double-edged sword. So they can, at any point of time, they can say that we will not honor your commitment. So many people or many institutions started to dump US dollar and started to purchase gold. Russia, India, Turkey, Poland, many of these China emerging economies started to purchase more of gold. This led to a gold rally and dumping of the US dollar. Now, if people start to dump the US dollar, then there is no other way but to increase the interest rates to make it attractive for the investors to purchase the US dollars again. That is the backdrop, and hence the long 10-year interest rates have started to rise. This when the interest rate starts to rise, this brings in inflation, and it becomes difficult for corporates to raise capital from the outside market because already the government itself is giving interest rates at very high levels, so they'll have to peg their levels even more higher to actually access the credit. With this as the backdrop, what we'll see what is happening in Indian context. In Indian context also, we were seeing a reduction in the interest rates since last 20 25 years. So of late, what has happened is the interest rates have were in a decreasing spiral on a monthly chart. In mid of March and April, we saw that the interest rates have started to spike. When the interest rates have started to spike and have come out of the falling range, that was a worrisome moment for us, and we highlighted that in April that if interest rate starts to continue like this, then the equity bull run what we might be seeing will be in a tough spot. And as expected, the equities started to tumble during that period, and we were also anxious what would happen, whether it would continue to go up or decline. Luckily, it formed a volatility contraction pattern, a bullish pattern, that it is a continuation pattern that the interest rates would rise. But post the RBI introducing the new legislation of making debt or government security investments lucrative for the foreign investors, and also the Iran US war subsiding and the oil prices coming down, all have in fact helped. And even in the Indian economy doing well with all these scenarios also, slowly the pressure on the interest rate started to come down. Now the 10-year interest rates are in a clear downward cycle, and they have come down of or broken down of this range. So we expect the interest rates to fall even further. This is a good scenario for equity investors, or even for bond investors who are investing in long duration bonds. So this is a good scenario that we can see. It is uh, it is something that is good respite for a couple of quarters. What happens when it touches the lower end? We don't know whether it will break down or will again come up. But broadly, if you see the picture, we are in a very narrowing range of interest rates. At some or the other direction, it should break out or break down in the coming years. So that is certain. And the cycle looks like it is always coming down. But if the cycle starts to rise up, then it is a problem for equity. But that's a longer term picture. If we look at the shorter term to the medium term, we are in a good position. The interest rates, the G-Sec interest rates have started to come down. Now let's look at the third chart, which is the oil. Oil, after touching the higher $125 levels, now it has started moving back in a decisive way. There is no hold, it is free fall. It has come to almost 70 to $75 level pre Iran war starting to escalate. This was the levels that was seen. Now we are at that level exactly. So our India's balance of payment, the because we are the largest importer of oil, no, that will completely subside now. Now we are back to the normal now. When I say normal, the normal before war. But before war, was it good? It's not that good actually, because there was already issues of tariff war. There was already we were having that the job scenario being shady because of the AI coming in. So these issues are still persistent. At least one issue has now subsided, the Iran war, because of which oil again has come down. The other problems still persist. That's the backdrop that we see. Now I'll show the another chart, that is gold. Now, what is happening to gold? The ultimate hedge against the Indian equities. If you look at the weekly chart, the gold is retesting its earlier support. You see the long candles that are there at the bottom of this, right? There's a very good support that gold is resting. It has already been 6 months at these levels. So it is last we saw these levels in Jan of 2026. Now it is July. So 6 months of nowhere. There was a peak in between and trough in between, but roughly it has been a range bound in the last 6 months. I don't think it will consolidate quickly and move. It will take some more time to consolidate. So gold right now is completely resting. 6 months is a critical time when we say for any asset class, because most of the asset classes, when we take the rankings, no, not just we, any other institutions, they usually take 3, 6, 12-month period to see the return performance. Now, once the 6 months hurdle crosses, right, and 6 months being an important data point, and if the 6 months, if the returns are zero in gold, so that's when the asset allocation decisions usually change of what is coming new into the asset classes. Now, that being one of the decisions, even in our small case also, the asset allocation mix has changed, that Deepak will be talking about in further discussions. But broadly, gold is now resting. Resting, I think it will continue to rest for some more time. Then let's see with what is happening now with the India equities. Now, Indian equities is a mixed bag. If I start with the large cap, Nifty is not doing that well. The Nifty 50, the top 50 stocks, no, it has been in consolidation range since last 2 years till 2024. And if I see how far is it from the all-time high, it is still 8.5% still from its all-time high. So it is still long way for Nifty 50 to recover and move. Partially, it is also because most of the FIIs hold in large caps, and the dumping has happened in the large caps by the FIIs, and that is the reason even for Nifty 50 also for underperforming. And now let's go down the market cap and see what is happening with other indices. Let's go one step down to Nifty Next 50. Nifty Next 50 is also consolidating, but at a better position than Nifty 50. It is like 7% from its all-time highs. Nothing drastic from Nifty 50. Nifty Next 50 is also more or less down by 7-8% from its all-time high. Let's go even further down. That is Nifty Midcap 50. Now, this is the interesting place to look at. Nifty Midcap 50 is already broken out. The news is not being felt because of other reasons. I'll show why it is not being felt. But if you actually observe, Nifty Midcap 150 is already broken out, retested, and now again retesting with its earlier resistance level. It's a weekly chart. So this we see a clear indication that the mid-cap 150 are a pretty strong bet. If someone has to put their money in the Indian equities, this is a good place to put the money in. That is one. Even if you look at from the valuations point of view also, Nifty mid-cap 150 is actually better valued compared to Nifty large cap or small cap. That is one. Now let's go even further downstream in the small cap to 50 space. Small cap to 50 also has broken out from the trending line, not from the horizontal line. Now, if I look at the percentage from its all-time high, it is somewhere around 3.5% from its all-time high. Better than large cap, not as good as mid cap, but small cap is slowly starting to rise. And then finally, we look at the micro cap. The micro cap is setting up fantastically well in terms of the technicals. I'll show what is happening here. In micro cap, firstly, I look at uh, from the technical point of view to explain like what is the scenario that is happening. Now, if you were to see from 2024, uh, someone would have noticed that there was a uh, first shoulder, and then there was a head, and then there was a right shoulder. So typically we see that it is like an inverted or head and shoulder pattern, which is a bearish pattern because this is the neckline, and if it crosses below, then there would be a steep fall. But what happened at this neckline? It did not break down. It took a solid support and it went up. So this gave us the first confirmation that this is actually not bearish at all. There is a bullish tone to the micro caps. But we still waited and saw whether the slanting trend line would it be broken to confirm the bullishness or not. Yes, it broke out. It broke out the slanting trend line of micro cap, and it broke out and again retested the same slanting trend line, formed a volatility contraction pattern, and then again further gave a further another breakout. This time a breakout with gap up and consolidating at the higher levels. Now, even if I see from the all-time high, what is the level? It is at around 3.5%, just like small cap. But micro cap structure is strong in terms of technicals. So the large cap pockets are not that great. Mid caps are fantastic, micro caps are good, and some bit of small cap is good. So this is definitely not uh, a market where everything is doing well. There are some pockets which are doing well and some pockets which are not doing well. It helps us to position where to move next. That's the high level overview of what is happening to the markets. And Deepak, you can go through what is happening with our small cases, and then I'll cover lastly with the market breadth.
Sure, sure. Yeah, and just to talk about, I mean, just to add to what Shekhar was talking about, the micro caps, right? So I think in the last session, in one of the AMAs, we've discussed about how the war is impacting Indian markets, and we've shown some research, right? So apart from, I mean, we entering into micro caps is not just tested by our rule-based algorithm, but also, as Shekhar has shown it in the charts. We've seen that it has clearly given a breakout, and it's further corroborated by the evidence that is given on this research paper. So I'll quickly show this to you. So this is a research paper that talks about the geopolitical risk on the Indian stock market. So this has data starting from 1990s to as recent as Feb 2025, where they're basically trying to understand what is the impact of geopolitical risk on Indian stock market. So they used the GPR index as a as a X variable, and the Y variable is the Indian stock market. So basically looked at did regressions on multiple regressions on Nifty 50, Nifty mid cap, small cap, and also micro cap, right? So when they've actually looked at these different charts, so here you can see, how Nifty 50 has done since a geopolitical risk, right? So basically, geopolitical risk is measured based on the top 10 newspapers in the world, the number of articles that they publish related to war upon the number of total articles, right? So it's a simple index which talks about the sentiment or the war-related happenings. And here you can see that, since any geopolitical shock, Nifty 50 uh, climbs down, and it takes many months to actually recover since the shock, right? So we see the same thing with Nifty 100, 200, and also Nifty 500. But when you look at Nifty micro cap 250, the you see a reverse phenomena happening, right? So it actually does well during this during these geopolitical shocks. And the reason behind that is, when such wars happen, we obviously have dependencies on crude oil, so the currency weakening happening. So when this happens, the gold imports will also cost us, right? The currency further devalues, right? So, but the micro cap, on the other hand, are highly resilient to such phenomena because they are mostly domestic oriented. So what they are serving is internal consumption, right? So these are mostly averse to such phenomena. And there's also charts around how, each, depending on the country that is involved in the war, how each of these indices are impacted, right? So when you see, if you see how when US is kind of involved in the war, you see Nifty 50 dropping down. You can see the chart, right? So that you can also see that with Nifty 100, it's dropping, Nifty 200 and Nifty 500. But if you see micro cap, it's not dependent a lot on how whether US is involved in the war or not, right? So that's a further evidence to our entry into microcap. Now I'll quickly share my screen around what's our small cases, how our small cases are doing. Just a second. Yeah. So firstly, I'll show you dual momentum quant strategy. We are at 13.64% since the time we've launched this strategy in November. And compare that with Nifty 500, which is a more equivalent index that we can compare with. It is at minus 2%. So roughly we've generated about 15.6% alpha over the benchmark since the time we've launched, right? So like what Shekhar has mentioned, we've in the recent rebalance, we've reduced our allocation towards gold and entered into microcap in the last rebalance. And when you look at adaptive asset allocation, we compare that with Nifty 500, which is a more equivalent index here. So far, we've been able to beat the benchmark. In the last few weeks, it's down the benchmark by about 2%, but we are expecting it to recover, the index to the strategy to recover. And we've noticed that in our back testing as well. There are times when it is underperforming the benchmark, but we've seen that quickly recovering, right? So we are expecting this rebalance to further shoot up, the blue line over the yellow line, right? So that's about the performance of our strategies. Shekhar, you want to now take us through the market breadth?
Yeah. So, as you've seen, I wanted to show you that so far we have looked at what is happening with the different indices, no, of Nifty, large cap, mid cap, small cap. But I also wanted to take you one level deeper into this to understand that while the equities are doing well, we should also take a cognizance of market breadth. I'll explain what market breadth is. Market breadth is basically, let's say, the Nifty 50, which has 50 stocks, is doing well. It is rising well. But underneath it, there are 50 stocks. And all these 50 stocks might not be doing well. Maybe only a handful of stocks may be doing well. And these stocks are actually pulling up the overall index. Then basically what it essentially is happening is that few stocks are doing really well and majority of the stocks are not doing good. So one way to quantify or measure market breadth is to uh, calculate the percentage of stocks within a particular index which are above 200-day moving average. So if we have Nifty 50, then we say for each 50 stocks, we calculate what percentage of stocks are above 200-day and what percentage are below 200-day. So if a higher number of stocks are above the 200-day moving average, then we say the market breadth is good. In a good market breadth scenario, then what we see is that it is a overall bullish regime. Whatever stock you pick, it will go up. And in these times, there is no need for a fund manager because anyone can randomly throw a dart, get a stock, and ride the trend. That has happened during a couple of times in the market. And then there are some times of the market when the markets are rallying, but the breadth is very poor. This is exactly the kind of scenario that we are seeing right now. So if you notice, I've just plotted the market breadth for the last 5 years just to give a comparison. So of the Nifty 50 stocks during the period of 2001 to 2022, that is post-COVID, the breadth was pretty good. It was around 90%, 95% of all the stocks were above 200-day moving average. Everything was in uptrend. And then slowly it started to fall because of the Russia-Ukraine war. And then again started to rebound and then another small bottoming and then finally rebounded. This was the 2023 to 2024 kind of market, again a bull run. So this is a 50% line. So whenever there is 50% or more number of stocks are above the 200 moving average, it is a good market where you can see a larger set of stocks moving up. In the last 2 years, we are seeing that market breadth to be deteriorating. It is now coming close to 50% level. So right now it is like a hand toss. Half the stocks are doing good, half the stocks are not doing good in the Nifty 50s space. And it also means that the market is still indecisive whether to go up or to go down. That is Nifty 50. Next, if I show Nifty next 50, okay. If you see Nifty next 50, again in the same position, that is we are around 50% halfway mark above the 200 moving average. Again shows a lack of decisiveness. But now if I see the mid cap is also around 50%. But notice mid cap 150. I showed that the mid cap 150 is already broken out. Mid cap 150 has already broken out, but the market breadth is not that great. What does it indicate? Indicates that few stocks are doing really well, and those stocks are only pulling the overall index above. Now, this is uh, a very careful situation because if majority of the stocks are not doing well, and by blindly investing in some of the mid cap stocks, we might actually lose money, or we might be at a disadvantageous position. So picking the right stocks is absolutely important in this scenario when the overall index is doing well, but the market breadth is poor because few stocks are doing well. Now, same is the case with small cap. Again, they're hovering at 50% range. Even the micro cap also is struggling to actually get to 50% range. Even though we saw that the micro cap index is doing well, but the breadth is poor. Only few stocks are actually rallying so massively hard. And that's the reason, if you see, there are few good stocks which are doing phenomenally well. I think Deepak also will be showing some of the stocks that we hold and how did they perform. So we had some very good stocks which have done extraordinarily well, and that is a very small place confined in the larger Nifty 750 universe, that the bull market is happening. The bull market is not spread across because we're just coming out from the sideways market. So the early stages of bull market, only few stocks will be leading, and that's when the contagion like will spread to a next set of stocks, and then finally to the last set of stocks. But the stocks which are initially in a good bull market, even when the markets are sideways, and these stocks are starting to do well, no? And if I identify the initial stocks that are doing really well and continue to hold them, when the bull market comes, I think we'll be in a much better position to catch the two baggers or three baggers. That is the process that we are in, and I think we've identified a couple of good stocks in our dual momentum strategy, and we're continuing to still hold them, and hopeful to ride them in the coming months and weeks. Yeah, that is briefly about the market cap breadth. To summarize, that the breadth is not that great. Few stocks are doing well. A large number of stocks aren't doing well. So it always makes sense to pick the right stocks in this kind of market than going aboard and investing across. Yeah, Deepak.
Cool. So me also quickly share my screen. I'll talk about a couple of stocks that we've held since March 2026 rebalance. So I'll quickly share my screen. So one of them is Loris Labs. So I'll actually start with Kirloskar. We've held that since March 2026. So this is where it was, and we've done decently enough, about 50 odd percent. Yeah, and 60 odd percent is what we've gained since the time we've identified Kirloskar. So this is one stock that has been rallying quite well and actually taking the portfolio up. The second one is Loris Labs. Uh, this also has done pretty well. We've held this since again March 2026. I think in one of the rebalances we exited, but we've also re-entered again when it kind of was testing the ground here. So overall, this has also seen about 60% um, rise in value from the time we've held this stock. So there are many other stocks which have done well, but these are a couple of stocks that I want to put in spotlight. Yeah, and yeah, so I think that's all from our end. We'll be happy to take any questions now. I think there is a question already about plotting GPR on TradingView. Interesting thought, Vamshi. Thanks for that. Yeah, I think we can add that. We'll have to check if there are any existing indicators in TradingView where we can just add that to the charts and see them. If not, we might have to do that through Pine scripting, which happens in TradingView. But we'll see by the next AMA if we can do that and share that with you. Where can we check market breadth? Shekhar, you want to take that?
So market breadth, there are a couple of indicators that are available. You can check them in TradingView, but the market breadth that I just showed is built by us. We have written a code in Python to fetch this and calculate. Maybe if possible, I'll share that code with you guys. But in TradingView, you can see this indicator called as market breadth access. You can search by NSE India market breadth. This is the TradingView indicator. In this, you can see what is the percentage of stocks above 200-day, that is in black color line, percentage of stocks above 50-day moving average in red color line. You can also see a different way also of the market breadth, not just the moving averages, but like let's say the net new highs. That is how many stocks have made new highs minus how many stocks which have made new lows. So if it is green, it means that there are new highs that are being made in the stocks. If it is red, means there are more number of stocks which are hitting lows. So a good patch of green is usually an indication of a bull market. You can just take a look at this previous 2023 to 2025, right? There's a completely green zone where all the stocks were hitting continuously new highs. And once it moves to white, it basically means it is undecisive. There are reds and greens. The moment it shifts to red, it is a bearish zone. So this is how we can understand what kind of market that we are in. There was also a question in the uh, topic. There was also a question in the Luma that people had shared on the book. What was that?
Yeah, just a second, I'll pull that up.
There's a question from Vishal. Do we expect to exit completely from gold and invest the rest of the allocation to microcap to 50? I think the question asked is similar to that in the Luma also, where
Hmm.
someone was asking whether you will move from gold to microcap. Okay. So yeah, we said actually we'll invest in 50% the top asset classes. So, but now we have invested 25% in gold and 25% in microcap. So to answer this question, what happens is whenever we get a signal that now, yeah, let's say we got a signal that to enter into microcap 250. Now this signal is not a binary like 1 or 0, yes or no. The signal actually that we have built actually comes up with a percentage of confidence interval also. Let's say it says that you can go ahead into microcap with 70% confidence, or it can say that you can go into microcap with 51% confidence. It'll also tell you can go into microcap with 90% confidence. So that range also is important for us. Now, if it is a decisive yes, go ahead into microcap with a certain threshold that we keep, let's say 65 or 70%, then we completely move to microcap and we don't even bother about gold, we completely exit. Now, when the quality or the strength of the signal is mixed, but the signal is saying that move to microcap with not that confidence, that is when we deploy it into split 50-50. So now you see 25% in gold, 25% in microcap. We'll again wait for 2 more weeks for rebalance. And after 2 more weeks, when we see that the signal coming decisively in one of the other way, then we'll move it that way. So this way, it will help us mitigate the quick transition and smoothen the nav curve. Yeah.
Yeah.
Great
And
question.
also, I think the recent data on macro indicators also suggests that India has been largely resilient to the war, or at least with crude oil prices dropping now, we're in a better position than before. And this cycle, I think, has been slightly different from the previous cycles when we're affected by war and crude oil, and that's a good sign. But I think the most concerning aspect for us is the monsoon, the rainfalls that we expect, right? So if how that is going to impact is something that we have to wait and watch.
Do you also see REITs in dual momentum in coming times? Any backtests? So Vishal, actually, we are contemplating to launch a separate small case strategy only on REITs and InvITs, but not include them in the dual momentum or adaptive asset allocation. So that asset class is completely different from how equities or commodities behave. That is inflation bet, real assets, physical real assets play, and it is uncorrelated actually with the equities and commodities. So these three will be three different pieces in one's portfolio. So soon, hopefully soon, we should launch a small case in REITs and InvITs only.
Yeah, I think Vamshi, you have a raised hand. Feel free to unmute and ask your question.
Hi, Shekhar. So, I mean, when you mentioned that REITs are uncorrelated, I just had a thought maybe it is because of limited data that is available, or or is it fair to consider that it is uncorrelated? Because REITs and InvITs, they are like very recent in the offerings, right?
Yes,
Actually,
that is.
there's
Go ahead,
an
Deepak.
index called REITs and InvITs, like Nifty REITs and InvITs, which has been there for a little more than like the InvITs that have been launched. So at least from the time that we have seen, like 2019, I believe, if I'm not wrong, we've seen that the correlation is in the range of zero point 0.2 to zero point 0.4, right? So which is quite low, which is very similar to what we are seeing with global indices.
Yeah, actually, we can show the data. We have a tool that we built. I think we can show different indices of what they're performing it.
Yeah.
Um, while India, Deepak shows the data. In India, what happens is since 2017, 2019, we have good data. But if we can take the use cases in US, Singapore, and Europe of the REITs that have been existent to get an idea. So what Deepak is showing is basically the tool that we built to when we actually launch a strategy, we backtest different combinations. So we are presenting on strategy A, Nifty REITs and InvITs, that is an index maintained by NSE. Now we'll compare it with Nifty 50 just to see how these two are moving together.
So basically, I've taken Nifty REITs and InvITs on one hand, and on the other hand, I've taken Nifty 50. And you can see how.
Yeah,
So the red line is strategy A, which is Nifty REITs and InvITs, and the blue line is Nifty 50, right? So you can see in the recent
blue line is
times,
strategy A. Blue line is strategy A.
yeah, sorry, Shekhar.
Blue line is strategy A, Nifty REITs. Red line is index, Nifty 50 index.
Yeah. So if you look at the 1 year rolling correlation, so here you
Yeah.
see that, right? See the range here. Initially, it's on the higher side, like 0.5 when it started. It's you see this from 2020, but the data is from 2019, right? So 1 year rolling correlation. So you start from 1 year after, right? So while it is around zero point 0.5 initially, but weekly it is retreated to zero point 0.2 to zero point 0.4 kind of range, right? So it's in the similar range that we've noticed with, in fact, international indices like Nasdaq 100 and S&P 500. So it's a good idea to also add this to your portfolio, that reduces the drawdowns and volatility of your entire portfolio. You can add a tiny portion of this as well to your portfolio as a part of a diversification.
Yeah, actually, we can do a quick exercise if you want. We can add 50% into REITs and 50% into Nifty and show how does it perform against Nifty 50. So what Deepak is trying to mention will become clearly evident. Now, the reason why you saw a sudden drop in correlation of REITs post 2021 is that the Nifty REITs index actually is day by day becoming much structured. New REITs are getting added. So earlier there were only two REITs, Mindspace, and there was one InvIT of IRB. Now there are more than 11 or 12 InvITs and REITs, and this index is getting stabilized as more and more that we speak. And hence that is causing very low correlation going forward with the Nifty 50 index. We'll check the NAV to show how smooth the strategy has become.
Yeah. Yeah, Nifty 50, I think, is too dominating here. Uh, I can reduce the allocation a little bit, rerun this. say put 0.75 here. 0.5.
Meanwhile, there's a question from Vishal. Wanted to understand why can't be REITs be in adaptive asset allocation? Why separate SC? Why separate small cap? Okay, so Vishal, adaptive asset allocation, it can it's more of an ETF based strategy than a pure stock or REIT selection. We can still ideate and think about it, but what we feel is REITs and InvITs, it is better to have it as a separate one than combining it, because that will when you add too much of into one asset class or one small case, no, it will become more or more like a very super diversified multi-asset kind of a strategy. Uh, while it will try to reduce the drawdowns, it will also reduce the overall returns aspect also. So we need a Sehwag, and also we'll need one Dravid. Uh, just like that, same way, in the same principle, dual momentum or dual momentum is the most aggressive. Adaptive is like a middle order or moderately aggressive, and REITs will be completely cushioning of the portfolio. Yeah, so that's the intent. Yeah, Deepak, you can.
Yeah, so I mean, I'm just straight away moving to the risk metrics here. The drawdowns are slightly lesser compared to just purely Nifty 50, right? And the volatility as well has dropped by more than 4 percentage points here. So overall, your Sharpe ratio and Shorten ratio have become slightly better because you are looking at rates here. And I think the current drawdown also shows that the drawdowns have reduced because you're taking something, when you pick something that is less correlated and you add that to the portfolio, your risk metrics particularly become better, not hampering your returns too much, right? So that's what you see it in the Sharpe ratio and Shorten ratio.
Right. Thank you. Thanks a lot, everyone, for taking your time.